I've come across risk excess of loss, risk XL, reinsurance, but I'm not entirely clear on how it works. Could you explain it with examples?
Sure. Risk XL is a form of non-proportional reinsurance that covers individual claims when they exceed a certain amount, called the retention limit. It focuses on large individual claims, unlike catastrophe reinsurance, which deals with multiple claims from one event.
So, it applies to individual large claims rather than total losses from a catastrophe?
Exactly. For example, if an insurer covers a commercial building worth $100 million with a $10 million retention, and a fire causes $40 million in damage, the insurer would cover the first $10 million, and the Risk XL reinsurer would pay the next $30 million.
So, the insurer covers the initial loss, and the reinsurer steps in after that?
Correct. Risk XL protects insurers from large single claims, ensuring they don't bear the full burden of a major loss. It's commonly used in property, marine, and aviation insurance, where individual assets are high in value.
Can you give another example?
Sure. In marine insurance, if a cargo ship valued at $50 million suffers an accident and the insurer has a $5 million retention, the Risk XL reinsurer would cover any losses above that. So, if the damage is $30 million, the reinsurer covers the $25 million after the insurer's portion.
That makes sense, especially for industries with high-value assets or significant exposure to large individual risks.
Exactly. Risk XL allows insurers to take on high-value risks without absorbing the full loss if something happens. It's a key tool for managing financial exposure from unpredictable, large claims.
Does the reinsurer set a cap on how much they'll cover after the retention?
Yes. Typically, there's a coverage limit. For instance, the reinsurer might cover losses from $10 million to $50 million. If the loss exceeds that limit, the insurer would handle any amount beyond it.
How does Risk XL differ from proportional reinsurance?
In proportional reinsurance, the reinsurer shares both premiums and losses from the start, based on a percentage. But in Risk XL, the reinsurer only steps in after an individual claim surpasses the retention limit. The insurer handles the smaller losses.
I see. So, Risk XL is designed to protect insurers from high-value individual claims, while proportional reinsurance shares risk on a smaller, ongoing basis.
That's right. Risk XL provides targeted protection against rare, large losses. It's ideal for protecting against events that could be too costly for the insurer to handle alone.